If you only have a couple $100 and you got a couple ounces sitting around here and there, that makes a lot of sense. But if you're somebody with more means of significance, you start to run into a lot of problems.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And in today's show, we have another video from Nate Fisher of Renaissance Man, where he looked at some of the different options that are available in regards to gold and silver, because obviously a lot of people see what's going on economically and get interested in gold and silver, but then have the question of what actually do I buy? What are the options? What is safe? And fortunately, Nate laid out a great presentation of some of the different choices that are out there, how he looks at them, and he made a video and sent that in. So going to share that with you today. And with that said, going to hand it over to Nate now.
Hi, everyone. Nate Fisher here from renaissancemen.org for another special presentation for Arcadia Economics. In this presentation, I wanted to go over how to layer your gold and silver investments. So what is the saying? You start liking gold and silver, and what's the first thing you hear? If you don't hold it, you don't own it. Well, there's some considerations to ponder with this. Well, how much wealth do you have? If you only have a couple $100 and you got a couple ounces sitting around here and there, that makes a lot of sense. But if you're somebody with more means of significance, you start to run into a lot of problems I'm going to show you in a minute. So how concentrated do you want it? Do you want to have all of your precious metals underneath your pillow at night? What options are out there to diversify? Everybody starts with the physical, but then you start to wonder, well, how much of it should I have? Where should I put it? What other options are out there? So with this, what I'm going to do is I'm going to go into a lot of these different layers. I want to evaluate some benefits and risks with all of them. So when I first got involved with this, I was looking at the YouTube channels where you start to see these stackers that have thousands of ounces, and they lay these things out, and I'm like, wow, that's awesome. Well, it doesn't take very long until you get a little bit along your way before you realize this is just a security risk. I need to do something else with my money. So with this, there's a lot of danger to doing things like this. People will post pictures of their stacks. They do videos of it. It's just a very, very bad idea for security purposes. So with this, let's also consider some of the locations. Now, if you have a stack like that, you 2,000, 3,000, 4,000 ounces, consider the fact that you could be living in an inner city, Chicago, New York, Philly, one of these big cities, and you could be living in downtown. You could have two shady roommates, a crime-ridden neighborhood. Are you really going to put 2,000 ounces of silver in your apartment? So you say, hey, you know what? Maybe I'm going to move out to the suburbs. That could be a lot safer, but you look in the suburbs and you can see robbery rings everywhere. They can be in and out of the house in 5 or 10 minutes, depending on their skill, their ability to understand what their target is. So living in a suburb doesn't give you any more protection. Then you got to start potentially adding security systems and the like. And you might think, well, wait a second, I got 1,000 acres on a farm. I'm safe. I got guns all over the place. Well, consider the fact that you could be going on vacation someday. And with this, you're on social media and you say, hey, look, I'm in Mexico. Now, anybody that knows where your location is and knows you have this stack, you're now a huge risk, at a huge risk of losing. So some of your security considerations you would want to think about here is, first of all, don't talk about your stacks online. Diversify to minimize your risk in any one area. I'm talking about layers of security here. You have to understand your risk. Don't disclose your address. I think that's probably a given for most people. Avoid announcing you're away from your home. Like I said, if you're on social media and your previous picture is this huge stack of thousands of ounces and your next one is, hey, I'm off to Mexico for a week, you got a problem. Be cognizant of people following you when you leave the coin shop. Now, I live in a pretty decent area, but this is something. I mean, if you're going to the coin shop and you're buying tons of stuff, I mean, you have to consider that there may be people that are following you to at least know where you live, not necessarily to rob you then. And also, don't tell people where you put it. Like, I have people ask me, hey, Nate, what's your brokerage you're using? Who are you vaulting with? I don't disclose these types of things, because if they understand what your username is, if they know um, what brokerages you're using, they may try to hack you or try to gain access to your accounts. So another thing to consider here is counterparty risk. I hear this a lot on the chats. I hear it about a bunch of different things. Let's just kind of go into it real quick. If you hold the silver in your hands, you have zero counterparty risk. Counterparty risk is the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. Counterparty risk can exist in credit, investment, and trading transactions. So consider here that you put silver in a vault. Now you hope that if silver goes up to 50, $100, you hope that your vault isn't robbed. You hope that the guy that's holding your silver is actually holding your silver and not taking your money and gambling it in a casino. You're hoping that if something happens, like a natural disaster, that you're insured. But so counterparty risk, unless you're holding it with yourself, you now introduce counterparty risk, and you're going to see this in pretty much every layer I'm talking about below. So one issue you have here is, well, if you have physical at home, you have this huge risk of theft or fire. So you have to then start to weigh with risk mitigation. So what is my risk of fire or theft versus what is my probability of counterparty risk with a well-respected vault? So those types of things you then have to keep in mind. So another thing to keep in mind as well is that PMs are a cyclical investment. So for argument's sake, you run out tomorrow and you buy 1,000 ounces of silver in a vault. Maybe you're 25, 26 years old and you want to hold it for 40 years. Well, that can go up to 50, $100 and come back down to 25. You have no idea. So it might be when PMs run up, it might be a good idea to lighten the load a little bit and maybe invested in real estate or the stock market. And at other times when the PMs are relatively lower valued to stocks and real estate, that might be a time to start adding to your stack. So some of the basic layers I'm going to cover here: physical, ETFs, vaulting, digital metals, crypto metals, and miners. With physical silver, the big things that you know about are coins, bars, and rounds, and also constitutional silver. So the coins, think about them as like the American silver eagles. They are made by the U.S. Mint, and because of this, it has a premium. And if you try and fake an American silver eagle, you have problems with the U.S. Treasury Department and the Secret Service. Likewise, many nations have their own versions of their own coins for themselves. So those types of things have a little bit higher of a premium. You have rounds, which are made by private mints. So then you have to wonder, is a private mint diluting their silver? Are they really giving you 0.999 silver, or is it diluted with something? So private mints then have reputations that they have to adhere to. Bars, you're thinking of 10 ounce, 5 ounce, 1,000 ounce bars. The bigger the bar, the lower the premium, but the harder it is to move. Consider you bought maybe a 1,000 ounce bar at $4 an ounce. You paid $4,000, 20 years ago, and you got this giant bar. Someday, maybe the price of silver goes up to $300. Now, you're going to lug this 60-pound bar. You're going to take that into a coin shop and demand $300,000. It's not very liquid in that situation. So that's easier to move if it's already in a vault. So keep in mind that maybe at your house or something, maybe you have some smaller denominations, which is why I would recommend people use junk silver, which is the constitutional. This is U.S. coinage, and other countries have their coinage. Before 1964, it was 90% silver. So why would you go out and buy fractional silver rounds at these high premiums when you can just go out and get silver U.S. dimes 1964 and below for dirt cheap? with the premiums. Now, some of the pros you have with this, it's in your hands. There's no counterparty risk, and it can be emergency money. Now, if you consider like a hurricane hits or something and the banks freeze up, you're not really going to first thing you run and get your American Silver Eagles and run and go and buy bread with it. It's not really going to work like that. That type of thing may come into play months into a crisis, but it's not going to be at play at first. Your U.S. dollars on hand are going to help out more than anything. But if your currency dies and there's a new currency getting stood up, this is something then that you can buy into the new currency system with this. Some of the cons, obviously security. Anything more than maybe 20, 30, 40 ounces per person in your household starts to run into a high security risks. Are you going to go out and buy a $5,000 vault for $1,000 of metal? No. So what you might have is just a small vault that you have. Maybe you already have guns or something like that at your house, and you add a couple ounces of silver in there. So be it. But when you start to look at higher levels of wealth, you have to start looking at how to diversify your holdings. Also, with this, I'm going to show you in the next slide. Here, you can have some really high premiums with silver. Now, this slide here is a year old or so, but the price of silver is about the same. This shows silver. I know it's probably a little small for you to see, but it shows the spot at 22.20, but APMEX is having American Silver Eagles for 39.78. So that is approximately, I don't know, twice the cost of the silver. Now, people think, silver's going to hit $50. Stories I've heard is that when silver was $50, people were lined up around the street, and when they went in to go hand over the silver, they were giving $35 to the people selling their silver rather than $50, because these guys buying all the silver had to then turn around and hedge stuff, and for all they knew, the next day silver's going to go down $10. So you could have bought this when silver was $20, expecting a $50 move. You could have bought it at $40. And then when you went to sell it at the coin shop 3 years later, they would have only offered you $35. So that is another question that I ran into with some people asking about silver. Hey, if I buy all this silver, is it liquid? Yes, to an extent. I mean, you can take this to pretty much any coin shop in the country, in the world, any jeweler, and you can, well, not any jeweler, but many jewelers I've seen, you can take it to them, and they'll give you spot. Maybe spot minus a couple bucks or something, depending on what you have. But the big issue here is that this stuff is very liquid to an extent. Now, again, if silver runs to $200 an ounce, are you going to take $3,000 down to the coin, 3,000 ounces down to the coin shop in a shopping cart and stand in line and expect this guy to pay you $200,000-$300,000? Not really. You may have to sell some of this in tranches if you're going to sell. So with physical silver, we covered some of that. With the ETFs, what are they? Exchange traded funds. So within the metals you have, for silver you would have the SLV, PSLV, SIVR. There's like 20 different ones right now. Many of us shy away from one and favor another, and I'm not going to try and play favorites here. But what they do is they have these big piles of metal in a vault, and you're buying into a share of this. If you're a large investor, you can buy large amounts of these shares, and then you can pull that metal out of there. So a lot of these companies like Toshiba, whatever, they don't necessarily have to hold anything with COMEX. They can, buy 100,000 shares of SLV if they want to, and then at some point in time, a year, 2 years, 3 years down the road, if they want to take the metal out, they just, say, hey, give me the metal. They load it in the back of a truck and they take it out. So we've seen something like that with SLV, where we've seen the metals actually leaving the vaults. So you could make the argument that you could be seeing large industrial people taking their metals. You could be seeing that. We've seen on the COMEX 150 million ounces disappear over the last 2 years. So you can see that there's been, last year, a 200 million ounce deficit, and you can see physically where these metals are being drawn out. But anyway, with the ETFs, they're easy enough to park large sums of money there. It's pretty liquid, but it's only during trading hours. You can buy call options on some of these if you think the price of metals are going to go up. So one of the problems you run into with this is that you put your money into these things and the vaults own the metals, not you. So in some of the cases, all the metals might not be there. I mean, it shows in their prospectus that, hey, look, at times we may not have all the metal. You may also worry about a nation saying, hey, look, this metal is dangerous to be sitting in a vault somewhere. We need to nationalize it. We'll give you par value for it. We'll give you fair market value today. We'll just pay you the cash out, but we need to take this metal. And then they'll just print out, currency on their side of things with treasuries or the like, and they'll just take the metal and give you cash and dilute the currency that they just gave you. So be careful that ETFs may not be around for 10 years. So there is a real risk here that money you put into there, you may either lose some of the purchasing power of it, or it just, one of these ETFs one day may just fold. So vaulting solutions, what are they? You have segregated, where with a vault owner, you may have a bucket where your metals are in there and they hold it separate for you. Allocated may be, hey, here's a pile of 100,000 ounces and you bought 20,000 ounces of this. So it doesn't matter what bar, but you own 20,000 of that. And unallocated, we've seen some of these types of things explode over the last couple of years. I'm not going to go into them too much, but one of these positions were more of, hey, we have metal within the entire supply chain. So some of this unallocated metal you're buying right now, it's free. It's free vaulting. Well, it's not really free vaulting, because what you've done is you've handed them money to then order it from a mine. And it could take 6 months for that metal to actually make its way through the system. So it may not be there when you go to get it. And in one case, their prospectus is talking it could take 6 months for you to get your metal. So unallocated has risks associated with it. Pros, they vary greatly, and they can be customized to you. You can have different vaults all over the country if you want, different countries. In some cases, it's your metal, like I said, with the segregated. Cons, it's not in your hands. What happens if your vaulting solution, what happens if they go out of business? There's some competitors to vaults now that may stand their business model on its head, and they may have to adapt. They may go out of business. What happens to your metal if they go out of business? What happens if the owner dies? What happens if the owner just, he was taking your money and gambling it instead of buying metals with it? So in some cases also, you may think that, hey, wait a second, that's your metal, it's allocated, I'm going to take it out. But in some cases, you may find that they've rehypothecated or sold your metals many times over to other people. So with digital metals, you have something like One Gold. I've used, I like it, but there are some issues with it. So when you buy something like One Gold, let's just say silver hits $12 again on some smash down. You can get in. There's a bit of a premium on it, but you can get in quick. And if the price of silver goes way back up to $18, $20, $22 real quick, you can turn around and flip that, and you have exposure to the price movement of silver, and it's backed by silver in vaults, but that silver in vaults can never get to you. What happens with something like this is you get cashed out, and then you have your best premium on AppMex, which you can then use to buy physical metals to get shipped to you. So that's kind of one of the cons with that, is it's vaulted metals, but you don't ever have access to it. With something like Kinesis or Cash or Load, I'm not going to get into any specific brand here, but the concept is that this is more or less a term I had coined with some others, asset-backed digital currency. So the concept is you have something on the blockchain, and that's a big, that's used for ledger technology today. But if you can then take that spot on the ledger and tie it to gold or silver ownership, that then gives you the rights to what's more or less title to what's in the vault. So with that, you can also buy fractions of ounces. You can also, with some of these solutions, you can spend this real time with debit and debit cards. You can send these metals to other people instantly, 24/7 for the most part. So with a kinesis or a cash or load, you get the best of both worlds, where you get the cryptocurrency, low cost of transactions, transparency, and you also get the ability to fractionally use metals and store them in vaults. In some cases, you get paid to store. With miners, miners are one of my favorites. I went way in on them in March 2020. I got I think my portfolio doubled in like 3 months. I thought I was a genius, and then I got brought back down to earth, like many of you. Miners, the problem that you run into when I first got into them is that people were recommending these miners. My buddy, who was a former IRS agent, I sent it to him. I was like, hey, can you take a look at the books of this? And he's like, Nate, these guys, they don't make any money. They don't mine anything. Well, and then I'm like, okay, they must be fraudulent. That's not the case at all. Miners are this weird type of industry where there's a lot of different types of miners. They could be explorers. They could be developing a mine. And in an explorer, you're paying for shares in a company with the hope that someday they hit it big, and the value of the metal in the ground gets increased by them proving that, look at all this metal that's there. Then you can also have junior producers. Then there's also other types of companies which are more or less like the banks for the miners. So there's a lot of complications in here, but overall there's massive upside that you can play with the miners. The cons are that the leverage goes both ways. Some of these miners you have, I've seen some of these go to zero. Now, luckily, I got out of many of them first, but you can literally see some of the famous names now going to zero. And likewise, this is also a cyclical investment, so you have to be careful about, bringing your positions down if you think the move in metals is over. So I'm not going to go through all this. I wanted to kind of put a slide out there if you wanted to pause this. This gives you a pretty good idea of the pros and cons for everything. So those are the basic layers. I have some other layers here. I added Chris's Chopper Ben picture. Have some fun with this. Some other layers here are futures. I've recently been doing this. This is typically not something a lot of the retail people deal with, but I've recently used it to start hedging some of my downside issues that you can run into with miners. You can see these things go up and down, up and down. But if your miners, move up 2x in a day, and you think, oh my God, silver's going to go flying way back down real quick, you can hedge that position, capture the move downside, and then take that money that you just made on the short from the futures and then buy more miners. So there's layers of complexity there I didn't want to really get into. You have derivatives out there. These big banks have these weird products that big money goes into that it's very hard to describe what they actually are. But I saw this one Bank of America. It had either the higher move on GDX or SLV, blah, 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 blah. And there's like $100 billion or something in this type of derivative. And it just bets on the action of the moves. There's not actually real metal or silver that the owner is buying. They're tertiary, secondary bets on moves of other things. You can also have collector silver coins. Like there's a picture here of the collector silver coins. So you can have, for instance, certain types of series that are out there. You can see that there's high premiums on. I can't remember any of them now. It's been years since I've dealt with a lot of them. But you can get an entire series that a mint might make that they're beautiful, they're collectible. You also have what's called the numismatics. Now, there's a picture here of the slabbed Morgan dollar here, where a general cull Morgan dollar, which is probably what you've seen for $20-$30 in a coin shop. The numismatic is a special value because of the condition it's in, maybe the rarity of the coin, and those types of things can get ridiculously expensive. And if you don't understand the market, you could just be spending ridiculous amounts of money on something that it could be a $20 coin and you're paying $100 for it because it's in a slab. It could be a ripoff. or it can be something that can go up monumentally based on a lot of other characteristics. But the last one here is fun. Occasionally I get some of these for gifts for friends or family. Here you can see a Spider-Man coin. So this is also maybe a way to get your kids involved with some of this. I was a kid dealing with junk silver, but my dad was trying to have me find mercury dimes in giant piles of silver in like 1981. I remember that. But it's also good sometimes to get your kids involved with some of the precious metals by having fun with some of these. So the premiums on some of them can be astronomically high. Maybe get them for a Christmas present or something, birthday present, but it gets them interested in silver. So with this is something also you can pause. This is an example, a portfolio that someone might do. I'm not telling you do this, that, or whatever, but this is something that people might do at home, is put a spreadsheet together and kind of figure out how much you want to have at home, how much you want to have in different types of vaulting, what exposure you want to have to different types of mining stocks. You have a major out there like Newmont, and their risks are very low. And you have other explorers out there that they are extremely high risk, that they can go to zero in a week or two. So you have to be very careful about your risk level in each one of these things. You also, on this portfolio, you might say, like for me, I might say, like, you know what, 10% of my portfolio I might have is like uranium, natural gas, nickel, copper, those types of things, battery metals. I might want to just diversify a little bit out of precious metals. So for many of you that have followed me, precious metals are my hedge against my real estate. They're not my primary investment. So many of you may have 401ks. You might have this big house. And if you think there's trouble coming ahead, you might want to put a portion of your net worth into precious metals. This is just a sample of what you could do with something like it. So what do I personally stay away from? I can't tell you one way or another, but high premium physical, like that screenshot I showed you up above with the AppNext, that was an outlier of a time, so I'm not saying anything bad about them at all. But there are periods of time where everyone rushes to precious metals and the premiums go sky high. I mean, if you're a precious metal dealer and you got 100 ounces sitting on a shelf somewhere and you're not getting any kind of supply for weeks, you got to keep the lights on. So premiums go up in situations like this. That's completely understandable. Now, the problem that a lot of them run into is that their supply chains behind them also have problems getting things quickly and spun up. So COVID really put a wrench in a lot of this. But I try and stay away from the high premium physical, which then allows me to look into the other layers. When premiums are really high, hey, maybe I look at something like, short term, do something with an ETF. I also stay away from unallocated metals. Some of these may be better than others. It's just not for me. Allocated pools, again, some of these things can be very legit. I kind of stay away from them. That derivative thing I was just talking about, like Bank of America. Now, if you're high net worth and you're sitting there on, $60 million of assets, you may have to actually go into these things because these metals markets are so small. You try to go in with a large order on these things, and you can double the share price in 10 minutes if you if you really try to get a large order. And so some of these derivatives may more or less be a sponge where it's absorbing the big money, and that big money is not driving up the underlying metals, which is another reason I should have added to my presentation last week about why the price of metals aren't going up, because there's a lot of these derivatives which act as a sponge. And instead of going into buying the precious metals themselves to drive up the price, they're going into these tertiary prepackaged things by these large banks that essentially could go to zero. I mean, they're playing on action on precious metals, and they're not the real precious metals themselves. Next, we have futures. I typically stayed away from this. I put this on here because, generally speaking, retail probably should not be anywhere near this. And then there's all kinds of other forms of derivatives I can't even think of that I'm sure many of you are going to point out. So with this, I just want to kind of leave off this rather quick presentation for me. Feel free to put any comments in the video, any questions. I tend to kind of lurk in some of these comments sometimes and go back and forth for you guys. If you can, please visit me at renaissancemen.org. I write about a ton of different things, mostly precious metals these days. Thank you. Bye.
Well, thank you, Nate, for today's video. Appreciate everything that he shared there and feel like he really did a good job of laying out a lot of the different options and giving people something to think about. Obviously, keep in mind, there is no perfect solution for everyone, and whatever someone else does may or may not be right for you. So again, just consider your own circumstances and what matches what you're trying to do, the amount of silver or gold that you have and the situation that you're in, and don't worry as much about what someone else is doing. But hopefully this at least gave you a good overview of some of the options to think about. And before we wrap up, did want to thank BlackRock Silver, one of the other options in terms of if you're looking for gold and silver exposure, because BlackRock has their projects that they have been bringing forward, one of which is at Silver Cloud, where they are getting ready to begin drilling a 4,000 meter drill program. They've completed the plans in the process of permitting. And this is the project where they had 52.62 grams per ton gold in one of their latest drill holes. And then when they did a metallic screen gold assay, they came back with 70 grams per ton gold. And they are looking forward to doing some further drilling there to further refine exactly what they have. And of course, as I've mentioned before, they also have their lithium project that they've partnered with Tierlock Resources on Tonopah North, where Tierlock is providing the funding for the development and exploration on that project. And they have a shared agreement where they will split the proceeds of any lithium mineralization that they do eventually recover. And of course, there is their flagship Tonopah West project, which they have been expanding after releasing their maiden resource last year. They recently cut 712 grams per ton silver equivalent at a northwest step out target, and they are continuing their expansion drilling to the west of that project. So looking to build on the resource that they released last year. You can find more about that at blackrocksilver.com, or to hear a bit more from Andrew Pollard, who runs BlackRock Silver. Well, there's an interview with Andrew that he did recently coming your way now.